Welcome to the Retail Focus Podcast, a weekly collection of news, interviews, and information from the world of retail. Here are your hosts, Trent Kling and Leighton Kling.
Welcome to this edition of the Retail Focus Podcast with Trent and Leighton Kling. A full show today coming up. We'll check in on holiday sales for several different retailers. We'll look at Bed Bath & Beyond's first earnings call with the new CEO. And we'll also talk about a grocer we don't talk a lot about that's in the value segment. We'll also have an interview. Our interview guest, Michael Hurst with Starch Creative. He's going to talk about retail design, specifically as it pertains to reimagining the retail space and also setting up those ever-important pop-up stores that are becoming more and more crucial, especially to online brand success. A quick reminder to like us, rate us, however you access us, whether that be on Apple Podcasts, Spotify, you name it. You can also check us out on Twitter and Instagram at Retail Podcast. A quick apology as we start the show. As you know, if you follow us on social media, my voice hasn't been up to snuff. It's been gone most of the last week or so, but hoping to make it through this podcast here with what little voice we have. And we start the show with those holiday sales figures coming out for several prominent retailers. We're going to go through this on a rapid fire, retailer by retailer basis. However, overall retail sales during the holiday season, according to MasterCard, were up 3.4%. Now, this is fine, but the one thing we do need to keep in mind is that these numbers are basically only inclusive of Thanksgiving through Christmas. So it doesn't include the period prior to Thanksgiving, as some of those estimates did. And we heard from several data companies, including Cardlytics, that sales prior to Thanksgiving were looking pretty good this year. Now, this is a major reason for this number being somewhat below estimates. You'll remember back in the fall when we were talking about estimates, a lot of people had that number around 4%. MasterCard's data had e-commerce sales up 18.8%, making up 14.6% of total retail sales. Again, a quick caveat here. These numbers may be pretty close to correct, but again, they come from MasterCard. Might be somewhat incomplete as to the estimate of cash transactions. Now, those are accounted for in the data. MasterCard just doesn't forget about those in the data. But cash transactions, of course, mostly take place in the brick and mortar realm. So after we see these estimates come out, it's usually not unusual to see a slight adjustment upward to those brick and mortar sales. But let's break it down on the individual retailer basis. And Leighton, usually it is mostly department stores coming out with these updated numbers.
Yeah, like with our last podcast, this is one of the podcasts we most look forward to. And when reporting on these holiday sales, there are going to be a few details that are a little bit different than in 2018. So you look at those sales figures in 2018, they had one additional week. So that's the caveat here. And all of these retailers, Trent, all of these different department stores have a little bit different way of calculating their sales. Some do it in a certain amount of weeks. Some do it strictly by going off of the November and December timeframe. So first, we'll begin with JCPenney. JCPenney apparently continued their overall struggles, reporting November and December comp sales down 5.3% from 2018. This is an adjusted figure taking into account the exit from appliances and furniture, which of course we've covered throughout the previous podcast. But without those adjustments, Trent, sales were down 7.5% on a comp basis for those 2 months. For them, this was a 9-week period ending January 4th. Besides the raw percentages here, there was a little bit of detail given in their comments on the sales. The sales numbers resulted in an over 10% decline in the stock price on the day of the announcement, Thursday, January 9th, for reference. This despite guidance being reaffirmed in their release. Again, just a few details there, not much given from the company. And you're looking at a company that has been in the news a lot as of late, and not for good reasons. Trent, in second here, Kohl's unveiled a 0.2% decline in the holiday season. Not terrible, but just like JCPenney, they're getting headlines for not all the right reasons. We saw Kohl's all over our newsfeed on both our Instagram and Twitter pages. People saying, "We told you so. Brick and mortar is dead and the Amazon partnership is not working." We're going to talk about that in just a little bit, but this is not indicative of the direction that many thought the company was heading a year ago. Talking about those positive statements with that partnership, this is inclusive of November and December combined. They did note continued increased traffic from their Amazon returns platform, which is to be expected. Whether it translates into actual sales within the store, we'll have to still wait and see on those details and those specifics. But the announcement caused a significant drop in Kohl's stock price of over 9% on Thursday, January 9th. This was despite Kohl's reaffirming overall guidance for the quarter in the release. Still, on Sunday's NRF sessions, which we've been seeing a lot of there in social media, Michelle Goss said that their initiatives are working and that people are still being driven to stores to shop. Again, she credited the Amazon partnership as a big reason for this. Specific points of strength she mentioned in both the release and her talk include active, beauty, and children's. Of course, we're seeing a lot more in those particular categories anecdotally when we toured those stores just prior to the holiday season. Beauty in particular is actually something Kohl's has been pushing of late, noting the reinvention of that area on their website in December. And Trent, I'll let you have this one, but we are going back to L Brands for just a quick moment here.
Yeah, we talked about L Brands on our close of year show where we talked about the most performing and least performing retailers. And I wanted to throw things back to a McDLT reference, even though I'm drinking chicken noodle soup for the show, so I have a voice. But going back to the McDLT, once again, it was about the hot side and the cool side of L Brands. These sales numbers are for November and December combined. On the hot side, same-store sales jumped 9% at Bath & Body Works, even above the increase we've seen in recent quarterly results. This is on top of 14% comp growth last year. Brick and mortar comps were up 4% on their own. Digital comps were up double digits. On the cool side, or the cold side, as it were, Victoria's Secret continued to be a hot mess, with comps down 12% over last year. Digital and brick and mortar struggled equally. Both were down 12%. Because of this decline, comps as a whole for L Brands as an organization were down 3%. And because of these struggles, L Brands reduced their earnings outlook for the fourth quarter from $2 per share in the quarter down to $1.85 per share. Still, slight increase in L Brands' stock after the announcement last week. And finally, we look at Macy's, who released sales results for November and December combined. Comp sales for company-owned stores were down 0.7%, which is honestly a little bit better than some of the recent quarters have been. Jeff Jeanette, their CEO, noted that their Growth 150 stores once again performed better than the rest. Those Growth 150 stores are, as the name would indicate, stores where they are trialing kind of new approaches to their traditional in-store setup, really focusing on those stores a little bit more. Those stores performing well. He said that was a positive, certainly, for the company. He also mentioned growth in the online channel and seemed pretty pleased on the whole with sales results. Now, sales were helped by departments licensed to third parties, which provided an impact of positive 0.1% to overall comp sales. Although Macy's stock did decrease slightly after the release on Wednesday, January 8th, the stock finished the week at $17.81, which was up for the week as a whole. Quick note here as we record, we would expect Target to release their holiday sales numbers sometime this next week. Well, that does it for the first story on the Retail Focus podcast. Coming up, we'll be joined by Michael Hurst. He's with Starch Creative, and again, he's going to talk about focusing on the design aspect of retail and really finding new ways to communicate brand values to consumers in a retail setting. Now, we're always interested in the design of retail. Often, so much thought goes into specific layout of stores, not only for purpose of customer flow, but also to achieve a strong sense of brand. And now, more than ever, facets of retail layout and design are crucial in this era of pop-ups and special retail events. And joining us to discuss retail design and much more is Michael Hurst. He's the co-founder and chief creative officer of Starch Creative. Starch Creative, a team that works with a wide variety of retailers regarding design, branding, events, retail marketing, and much more there. Michael, thanks so much for joining us here on the podcast.
Thank you so much. Excited to be a part of it.
So we wanted to kind of start with the genesis of the company first, just so that our listeners know kind of what perspective you bring and where you're coming from with this. All ideas when you go to start a company kind of have its genesis from a need. What was your aha moment as far as seeing a need for what you guys at Starch Creative bring to the marketplace?
Yeah, That's a great question. Well, like most companies, we started pretty small. Right now we're pretty much 80 plus individuals working together. But when we started, it was my business partner and myself. We were working with a brand, the Vans shoe company, part of the corporation. And we had just been doing it for a while and doing it very well and looking for whatever challenges we could take on, traveling the world, doing just amazing work. We just kind of said, you know what, we feel that there's something bigger out there. So our aha moment, if you will, was going, there's got to be something more that we can do and impact more brands. And that's kind of how we went about, forming the company is like, there's something exciting out there. We could bring the value that we bring every day. And specifically, our focus was really coming in at it from a different angle, not really being from an agency angle, but more from a brand, from a retailer's angle. So really the anti-agency, if you will. And our objective was to be the best brand partners we could possibly be. So the aha moment was, let's do more. Let's work with people that can't necessarily afford bringing on a full team. They could, hire specialists in that area and execute accordingly.
Now, because of how well diversified your company is overall, and you mentioned it, a small team can do a lot for one retailer there at Starch Creative. What does your day-to-day at Starch, not just you, but the rest of the company, what does that day-to-day look like?
Yeah, it's pretty much, I would imagine, with any other brand. And actually, when I'm saying brands, with retailers as well. We look at, the projects that are at hand. We get briefed in by the project managers and account managers that run our projects for us. My role is a little different, but the team is very centered and we work very collaboratively together. We have individuals that lead us through each stage of the process within each project as well, be it, strategy and or just project management, getting the briefs in so we could scope back correctly to the client so that we're all on the same page. So day to day, get in and hit the ground running and just make magic happen.
Now, you mentioned in the beginning kind of the anti-ad agency, if you will. A lot of times we see retailers, brands have almost like an adversarial relationship with an ad agency. What's the process as far as walking with the retailers, your partners, so far as determining what defines effective design for them and what they want to get out of the process as well?
Great question. And this is something we talk about almost every day. So the difference of what we bring to the table and our focus, again, like I mentioned earlier, is that we wanted to be the best brand partners possible. But you have to have some foundation and background to that. So our foundation and background was we know the pain points of retailers. We've been there. I've spent 30 plus years in my career on the brand side with retailers and the business side of it. Obviously, I run creative, so I'm also very, very interested in what it looks like. So our main objective was to be really sensitive to all the pain points and try to be the go-to individuals and or company and or team that could set the retailer up for success and basically add value every day because, they have a lot of choices. They can either do it in-house or you can take it out of house. And again, we're just an extension to that. So we wanted to bring, the years and years of experience and knowledge that we had and really apply that and really focus on those pain points because there's plenty of them out there.
And you mentioned the pain points. I don't want to necessarily, out any of your customers' needs or anything like that. But at the same time, in your experience, what are the things that these retailers come to you needing most? Where do you find retailers maybe struggling the most to fulfill one of these design needs in-house?
Well, working with a bunch of different retailers, I'll kind of just narrow in on one specific group. So the big thing is they already know that we can make things look beautiful. But really, it's so much more than that. And design, store design, layout, visual merchandising, it's really making things look more beautiful for a purpose. And that's to move product, quite honestly. That's what we're all in this game for. And, they would come to us and, request the strategy behind, so the why behind the design. And we spend a lot of time talking about that. And we spend a lot of time really fleshing that out. Because there has to be a why. The strategy plays a very, very significant role in our company and within our strategist team that we have on staff as well. Making sure that we're executing and designing solutions that are going to add value, as I mentioned earlier, every day to the retailer. They come to us. It could be as simple as, hey, we want to rethink our new shop and shop program. But we want to come from it from more of a business point of view. So we'll dive in deeply into the business plan. The business plan, the assortment, the space, et cetera. And then additionally, they may need visual merchandising guides, the how-tos, the whys. So how to communicate to the staff and why does it matter? And that's what, in a store, that's what everybody wants to know. If they're boots on the ground, they're working in a store, is what am I going to do every day that's going to add value to the brand I'm working for, and it's going to make this look better in the customer's eyes and ultimately help them.
And I wanted to ask too, because you do come from a retail background, everything now is so individualized. We saw 20, 30, 40 years ago, it was very much one size fits all. Every planogram looked more or less the same. But now you're talking about not only companies individualizing things for their particular customer, but also we're talking about much quicker merchandise turnover as far as seasonal merchandise and the like. So what kind of challenges does that pose as far as getting to know not only the retailer, but also the customer base and what that customer base wants?
It's interesting. Everything's about speed now. We have so many amazing tools out there from an analytical point of view. From a design point of view, we can execute so much faster. But the key to being successful is we have to break down a lot of the old barriers, be disruptive. How can we be disruptive? Looking for new ways to present product within a store. It hasn't changed much over the philosophy, the methodology of, basic retail, if you will, is pretty safe. And it's a proven fact for many years. And you typically have your group of fixtures that work together and seem to work in a very safe way. But our approach to that is how can we disrupt the retail environment and to set something askew, if you will, to get someone to look at something different and to draw them in. We use a lot of principles and thoughts that kind of outline that whole customer journey as we design and start thinking about retail.
We've heard a lot of retailers, you mentioned safety, even talk about the fact that safety in this day and age is almost a fatal aspect of a business. Well, as far as what people can expect to see in store, let's say I walk into a retailer that you partner with at Starch Creative. What's something that the average person would be surprised by as far as what the thought is that goes into it? Maybe something that they don't even think about going into that store that Starch Creative has had a hand in.
Yeah, that's a good question as well. So it's interesting. So the average consumer, shopper, let's say, probably don't know a lot of the behind-the-scenes events that happen with any retailer and any design firm, if you will, that's putting together a thoughtful merchandising assortment and or a thoughtful shop-and-shop concept, or just, a seasonal execution. The biggest thing that's kind of hidden from the consumer, if you will, is really strategy. And, you could perceive that and qualify that however you'd like. If you want to say it's manipulating the consumer in a way, it's really manipulating the senses of the consumer. In a positive way, I always like to think about it, is our objective is to really to engage, inspire, and educate, if you will, the consumer on any type of presentation, design, store design, or pull together that we're doing to captivate them and again take them on the journey. So, if it's setting fixtures and other visual media in at different areas in different ways, if it's instead of hanging from the ceiling, it's coming from the ground up, it's how things could work together and how these visual tools, if you will, speak together that can create a very disruptive environment. And strategy does have to play a role within all that, because what you want to do is make sure what you're doing is going to get the desired results that the brand or retailer has to be to achieve.
I mentioned it briefly in the introduction, but we're seeing a lot of, and we saw this last holiday season, a lot of brands turning to pop-up concepts as an answer to getting their product out there, meeting people where they're at, so to speak, because it's become an increasing part of the retail landscape. I know that's something that you at Starch Creative work a lot with. What are things that retailers absolutely have to get right when they consider a pop-up and something outside of their maybe traditional retail focus?
The first thing is be true to the brand. So, obviously, if they're first time at a pop-up and or if they're an online retailer taking it to a brick and mortar pop-up short term, they have to be true to the brand. Or even if it's a brand extension or a line extension that they're doing a pop-up with, they have to stay true to the brand so the consumer knows who they are. Number one, that's critically important. Number two is it has to be disruptive. It has to be engaging. There has to be something different that will want the individual to spend some money at that time or spend some time in that environment. So, if it's experiential retail, if it's engagement points, it's technology, it could just be the way the store is laid out and the stories that the brand is telling is so critical. Stay true to yourself as a brand. And, who doesn't want to feel special when you walk into a retail store? So that's why we do retail, to make the customer feel special, because they have a lot of options online. Let's do a better job, with these pop-ups and get these people excited about being there.
Now, I know sometimes projecting into the future can be a fool's errand a little bit, but we did just enter a new decade, so I felt like it was pertinent maybe to ask you about this. What's one thing that you can maybe foresee in the retail landscape in 2030 that might not have entered our collective consciousness regarding retail here in 2020?
Wow, that's a great question. 2030, let's see. And I hope retail has kind of found its way back by then. I'm a digital geek freak, so I love gadgets. But I also like a philosophy of less is more, if you will. I like to go into an environment and just be engaged by all the beautiful elements of the product and the way it's assorted and put together that builds engaging presentations. And not always tech, but I do love tech environments as well. So I would say, retail's just going to get smarter and smarter. I'm going to hope that we can get back to just making beautiful spaces, getting the product to where it's self-shopping. Let's simplify that, with the QR codes or whatever methodology that is going to be available to us. But let's find a way to be amazing storytellers. In 2030, let's just give our visitors into the space an out-of-home experience, if you will. Just really transport them into just a magnificent feeling of being in a retail space for the brand. And, by that time, by 2030, we're going to have different techniques of, be it digital and or analog, that will engage with consumers. So I think a lot of it is training. I think we're definitely right now training consumers on how to shop with all the digital. Good and bad. Again, I like gadgets, but I also too like true hardcore retail to where we're putting together beautiful, engaging product stories. A lot of cross-selling, making it easy for the customer to understand what the brand is, the value it can play in its life, and make it easy to make that exchange, and make it less transactional. Make it simple for the customer. I think that's where we're going to go for the future. And I hope, again, like I said, that we just start getting back to the elements of beautiful retail and beautiful, appropriated, if you will, visual merchandising techniques that engage the consumer.
Great stuff. Well, if someone wants to learn more about Starch Creative, or if a retailer out there wants to get in contact, what's the best way to do so?
We're on social media at What's Your Starch, and also online at what'syourstarch.com. And we are in 2 locations, actually. We have an office in Portland, Oregon, and we have an office in Southern California. You can always look us up in any of those methods.
Once again, Michael Hurst, the co-founder and chief creative officer of Starch Creative. Thanks so much for joining us here today on the podcast.
Had a lot of fun. Thank you so much.
Well, once again, we thank Michael Hurst for joining us. You can check them out. He mentioned this, but I do want to re-mention it at what'syourstarch.com. As we head on in the Retail Focus podcast, we said we were looking forward to Bed Bath & Beyond's earnings call after the executive suite saw massive turnover, but not even analysts, Leighton, could have predicted where the retailer came in on earnings this week.
We talk about negative coverage in the retail industry. This more or less deserved it. We look at the numbers here for Bed Bath & Beyond's most recent earnings call. This was for their 2019 fiscal third quarter. The big news was a massive miss on earnings, as analysts projected adjusted earnings of around 3 cents for the quarter. If that weren't low enough, Trent, instead, adjusted earnings weren't really earnings at all, but rather a massive loss of 38 cents per share. It depends on how you look at things. You could look at things in a multitude of ways with this particular call, but whether you view this as a necessary adjustment under the new CEO, Mark Tritton, or as an unexpected step back, giving Tritton far more of a hole to dig out of. Either way you look at it, not a good look for the company right now, as the company is going in a new direction. They have a whole new executive team. As a result of this most recent loss, though, the company also withdrew their 2019 guidance, pulling way back on expectations. This rarely happens where a company isn't comfortable even giving guidance for the upcoming quarter, but they did mention they expect continued pressures on sales and profitability. So pretty much more of the same, and that the same is a downward trend. The earnings per share surprise was likely a factor in the share price of the company dipping around $3 per share on the morning of the call, which was Wednesday, from around $16.66 per share to $13.66 per share. However, the share price did increase somewhat late in the week in trading, closing the week at around $14.56 per share, still down around 13% from earlier in the week. However, we hypothesized that if the company had released updated expectations for the fourth quarter, the stock may have fallen a little bit further depending on what they had to say there. This earnings per share loss, though, came despite what the retailer referred to as a better than average 5-day holiday shopping period. Still, comp sales on an adjusted basis declined 3.6% year over year. On a non-adjusted basis, it was worse, down 8.3%. We're going to talk about what that adjustment was for. The adjustment was to include Thanksgiving and Cyber Monday in both last year and this year's figures. You'll recall that both shopping events took place earlier last season, meaning there was, as retailers have been mentioning, 1 week less of holiday sales in 2019. This is something I sort of talked about at the beginning of this podcast. So numbers are going to be a little bit different regardless of how you look at it, Trent. Bed Bath & Beyond not reporting favorable sales comps. Typically in these situations, we see brick and mortar stores as the culprit, but in this case, sales were down nearly equally across both channels for the retailer. Bed Bath & Beyond has struggled on the digital front as of late, and this latest quarter continued that trend. Although we tend to think of both channels as being equally important, the vast majority of their sales come from brick and mortar. After all, we could see analysts being particularly negative about those digital sales struggles nonetheless. And you look, the one positive here, Trent, from the calls, those 5-day holiday figures that they said were pretty strong, running from Thanksgiving to Cyber Monday. Those were up a whopping 7.1%, which was impressive, but also perhaps a partial result from the overall shortened holiday shopping period and those more condensed sales.
And one thing we should note about that figure, because that does sound positive, maybe you think things are going in a positive direction, but it is very clear based on call comments from the folks that were on the call from Bed Bath & Beyond that the positive holiday sales do not indicate an overall positive trend. Again, the company withdrew guidance altogether for the fourth quarter, so you know things aren't good. Now, despite the lackluster numbers, their slideshow accompanying the earnings release was basically propaganda. Actually, I thought it was almost slightly humorous because it included a slide that had a welcome to New Jersey picture and talked about Mark Tritton's first 66 days as president and CEO. Now, this slide had language like, and I quote this, fully immersed in the business and initial enthusiasm affirmed. Not so enthusiastic maybe after those sales numbers, but the slide also noted the, and I quote again, the open invitation to create and lead change from associates. Now, this presumably does not include members of the front office that were let go recently, but the big emphasis on the call was change and the expected early 2020 rollout of their strategic plan as they look towards chipping back towards positive sales figures. However, there was some admission that the results seen in this earnings call indicated short-term pain, and a lot of that short-term pain. Tritton was none too happy with the numerical results, even calling them unsatisfactory. He didn't even say, hey, this is a product of a recovering retailer. He said, hey, this isn't going to get the job done. But their goal on the call seemed to be to persuade analysts that the path back to success is going to be gradual. Tritton said several times that it's not going to be linear. In other words, they expect several potential soft quarters before turning things around at some point in the future. You might see some pullbacks and forth as you try those different mechanisms to try and drive traffic. Now, the chief concerns have to do with their digital platforms, but also their softer connection with Gen Z and millennials. And they may indeed be connected. I wanted to mention this because we saw some coverage of the call afterwards talking about how their e-commerce setup might be struggling, but it might not be all just the website and the mobile setup. Because when you look here, their connection with Gen Z and millennials being soft, especially their brand connection, might be a cause, but not an effect of their reduced digital sales. Basically, I'm saying because their connection is so soft with those two age groups, their digital sales are struggling. Now, one thing we would caution against is that more recent data suggests that Gen Z doesn't necessarily value e-commerce as millennials do. And in fact, they might prefer brick and mortar. A few recent interview guests have alluded to this phenomenon. But Tritton did say that in order to be competitive in this space with other retail pressures about, they need to have a true omni-channel presence and one that is free-flowing, just like the one he came from at Target, though he didn't mention Target by name, especially for those customer bases who shop digital first. Now, he mentioned pressures. We've talked about those pressures before, but they include increasing strength of general merchandise retailers in the home goods space. Tritton did say that before coming over to Bed Bath & Beyond, he viewed them as a competitor, which really speaks to how Target saw home goods as a part of their general merchandise setup, but also a swell of support for off-price retailers in all of this. Tritton unveiled 5 pillars on the call as well, and some analysts asked questions about this. It kind of sounds a lot like Macy's 4 initiatives as actually, but they are product, price, promise, place, and people. So 5 things, all starting with the letter P. And while this may be helpful for the leadership team, one thing we've noticed in the past, and I think if you've ever worked retail, if you've ever, especially on the ground level of retail, but if you've been in and about a retail store, one thing that we've noticed is these pillars, these sayings, these catchphrases usually end up dying a death on motivational posters in the employee break room. I'm going to just be honest with that. It's oftentimes difficult to mobilize these on the ground level. So that's why I say it might be meaningful for upper management, but I don't honestly see these as being meaningful for ground level employees in the slightest. Everyone's placed importance in these type of platitudes, including Sears, and we've seen, obviously that hasn't worked out well for them, but generating buy-in amongst the most important employees, those ground level employees, the ones that are interacting directly with customers, is going to take more than just 5 pillars. They have to have a tangible reason to buy in, and that's sometimes why we don't see a lot of value in these corporate platitudes. Like I said, maybe it helps the organizational and the leadership team to stay on track, to stay on target, to create measurable goals surrounding these 5 pillars, but it's not something, honestly, that we see helping out those ground level employees in terms of turning around this company.
Now, as far as the short-term actions they are taking to facilitate that change, they discussed an aggressive sale-leaseback program that saw them generate over $250 million in net proceeds. This includes 12 retail locations, a distribution center, and their corporate office space, which is quite interesting. They mentioned that after these deals, they will experience an increase in net occupancy costs of around $11 million, with lease lengths between 12 and 18 years, depending on the location of those 14 properties. So some quick back of the napkin math tells us that we're looking at around 4, 5, 6% cap rates, which is below industry average, especially for a retailer that many of us see as lacking the strength of other retailers within that cap rate range. Think of a Starbucks, a CVS, a Walgreens, which is usually who you would see. And honestly, Bed Bath & Beyond, for all of their struggles as of late, maybe not as strong as those retailers I just mentioned. So this is good news for Bed Bath & Beyond because they're able to extract a bunch of liquidity, help their balance sheet in the short term, and reinvest that capital into other projects. And potentially this is not the greatest news for those new landlords, depending on the type of deal that they were able to sign with those lease agreements. But this inflow of cash, like I was alluding to, they hope will assist them in making changes into those digital investments and other key initiatives throughout the company. They also announced that despite previous plans to close 60 total stores, 40 of which would be Bed Bath & Beyond stores, they are changing those plans. Now they are seeking to close just 40 stores, 20 Bed Bath & Beyond stores in the first half of fiscal 2020. So that's good news for those store employees and those landlords. assuming they don't own those stores. Of the 20 stores they aren't going to be closing, and part of this is to reevaluate those closures and closures overall within their system. But part is also for timing's sake, as they want to work on clearance and sell-through mechanisms for the 20 stores whose closures are no longer imminent. They do plan on opening 10 total stores during fiscal 2019 as a whole, but a far less number than what their store growth used to be about a decade ago. We wanted to talk about a retailer we've discussed a lot internally, and by internally I mean when we're not recording, we talk about retail. Yes, we are that boring, but we haven't talked about this particular retailer on the show for a while. Save-A-Lot food stores caught our attention with several curious and high-profile closures last year, including one store that had been open for less than a year. This chain has actually had stores in 33 states, but also operates from a combined model of corporate-owned stores and franchise stores and licensed stores. So a different mechanism. Oftentimes, Trent, you can find a metropolitan area where Save-A-Lot does business and find all three working together in different distribution platforms. It's quite interesting. As such, there's a little bit less consistency from location to location in terms of that product selection. We always talk about square footage for these individual locations. We've seen them as big as 18,000 square feet and as small as around 12,000 square feet. And their overall appearance. Some are just frankly nicer than others. However, they hit on our radar again late last week as they reached a deal to gain much needed capital as they seek to expand and refresh their current store network. And of course, Trent, those current stores, we would assume, are performing pretty decently as they've been trying to close down those underperforming stores throughout the last couple of years.
And of course, they're a private company now, so we'll talk about their overall performance here in a second. At least their recent history performance hasn't been so good. But Save-A-Lot reached a deal that was announced last Friday, January 3rd, on behalf of their owner, Onyx, which is a Canadian private equity firm. And by the way, one of Leighton's former employers, in a way. Onyx has holdings all across North America, currently has $38 billion in assets under management. They recently acquired WestJet to give you an idea of the breadth of their holdings, but they also have holdings that include SMG, which manages stadiums around North America. Save-A-Lot was initially acquired in a deal they struck with Super Value prior to the latter being acquired by United Natural Foods. The sale was part of Super Value's larger movement at the time, several years ago, away from brick and mortar stores and towards their wholesale business. Ended up with them getting snatched up by UNFI. Super Value felt at the time that a focus on their wholesale and B2B branch would open up margins, which were struggling mightily on the brick and mortar front, partially attributed to Save-A-Lot's performance. In any case, the deals with Save-A-Lot's lenders, what they do is they allow for the restructuring of debt as well as the opening up of additional capital. Think of this, if you're familiar with mortgages or house financing, it's like a cash-out refinancing of a house, only in this case we're talking about business debt. The deals in aggregate will actually open up $138 million in new capital to give increased liquidity to Save-A-Lot, which is important for a chain that, as Leighton mentioned, has had its struggles. It's been closing down stores. It needs that money as a capital infusion to help fix up some of the stores, but also figure out where it's going in an atmosphere where value food retailers are doing really well with Save-A-Lot accepted. Now, additionally, these deals will cut debt by over $400 million and reduce interest expense. Not a surprise to see businesses, generally speaking, taking advantage of lower interest rates that we're seeing. Rates continue to fall, of course. We see the Fed reducing rates, but even rates among private lending continue to fall for new bonds and the like. Now, CEO Kenneth McGrath said in a prepared statement that the deal would allow Save-A-Lot to compete effectively, although it speaks to the fragility of the business that they required this deal to truly compete in the first place. If this is what was holding them back from truly competing in the grocery space, it's kind of a dangerous sign for Save-A-Lot as a whole. Now, as expected, McGrath kind of spun it in a different way, saying that the ability to strike a deal on its own suggests that others see strength in Save-A-Lot's model. Now, the Supermarket News estimates that Save-A-Lot took a massive hit on the sales front in the 2018-2019 fiscal year. So to Leighton's point, not the current fiscal year, but the prior fiscal year, the estimates weren't pretty. Sales were suspected to have fallen by 9.2% over the prior fiscal year, including the impact from closures. in numerical form from $4.35 billion to $3.95 billion. And a good portion of this was a reduction in store count over time from 1,344 stores down to just 1,252.
If we look again at back of the napkin math, it suggests that their comp sales were still down in the 2 to 3% range over that particular period. You're going to be doing a little bit of dividing there and trying to figure out, with the reduction in store count, how have they performed? And regardless, no matter how you look at that math, Trent, it appears as though they've dropped in terms of those comp figures, which is no good when you see that food inflation was actually up slightly, and other retailers, even Albertsons, which we reported on here recently, we're seeing comps in the positive low single digits, either matching or exceeding current food inflation numbers. What's more, the latest numbers suggest store count is down even further, as Save-A-Lot now says they have just over 1,100 corporate and licensed stores. That would be a reduction of around 18% in terms of store count. And you look, Trent, this is a retailer that does serve a particular population. They serve a demographic, and they've done a decent job of it over the last several years. It's just trying to know your audience a little bit better, handling inventory, handling supply chain. We think that there is a massive room for improvement. And to your point about having the executives know a little bit better about where to divert that additional capital that's going to be infused from this new deal. Their debt is now restructured. They should have a little bit more liquidity, which means in turn, they should have a little bit better cash flow to maybe execute on some of the initiatives that they've been talking about for some time. Because a retailer that's struggling, typically, if you're seeing a high debt level, if they're highly leveraged, they have less cash to do with what they want in terms of trying to rebound and remain competitive. And as the executive team has said time and time again with Save-A-Lot, they need to remain competitive in the grocery space, because if there's one thing that the Walmarts of the world and the Targets of the world can compete on essentially to zero, it's price. They can invest in price basically to see that their margins shrink down to a point where they're barely sustainable for the long term. But that's essentially what they've done there. And they're also now competing on, guess what? Not necessarily affordability, but in terms of convenience. They're delivering these groceries to these areas that what you would call essentially a food desert, which are the exact areas that Save-A-Lot serves. And so you're saying that competition is coming from a slew of different fronts, and it's up to Save-A-Lot now to make the right decisions. Whatever they're going to be doing going forward has to be with the mindset that the stores that they have remaining within their network are going to be unit profitable. And I'm curious to see where they go with this rebound and additional capital infusion.
And I think part of that capital infusion is likely going to go towards, again, refurbishing, renovating, especially the corporate-owned stores. And we've seen some of the licensed stores or franchise stores, so to speak, be larger square footage. But the company did actually, late last year, open up a concept store in North St. Louis. It's about 17,000 square feet with 12,000 square feet of selling space. And Leighton, honestly, when you look at the pictures of this new store, it looks like a combination between an Aldi and a Walmart neighborhood market, for those that are familiar with those two chains. Fruits, vegetables set up a little bit more like that Walmart neighborhood market, but most of the shelves, the way they're stocked, reminds you a lot of an Aldi. But the key that they mentioned when they opened this up is high efficiency HVAC, LED lighting throughout the building and the site. And we've talked before about how using LED lighting, particularly in coolers, helps to keep those electric costs down, but also an energy management system and low-flow plumbing fixtures. Save-A-Lots, again, if you're at all familiar with Save-A-Lots, they're usually in older, more antiquated retail spaces. So this infusion of capital is going to be crucial to bring those spaces up to par, saving long-term on energy costs, saving on a store-by-store level to where, maybe they don't need that massive margin on product anymore, and it allows them to compete more on price with Walmart. Likely result of this capital, that's at least what we would guess. But again, like Leighton, I'm anxious to see how they go about renovating the stores, especially in the near future with this new cash infusion.
As always, we may have a position in or against companies we discuss on the podcast. Do not invest in stocks solely on the input of the podcast hosts.
We've reached the final segment of the Retail Focus podcast, a segment Leighton and I both call Looking Ahead, where we look ahead to a story we're keeping an eye on for the next week, month, or year. I'm going to go first because if I wait, I may not have a voice to talk any further, but my looking ahead really has to do with NRF. NRF just kicked off. We had to, again, delay the recording of this podcast, but as it turns out, NRF kicked off over the weekend. And as we so often do, we see a number of articles talking about the future of retail and where retail is going. And my looking ahead story is not so much a looking ahead as it is maybe a resolution for those of us that cover retail to keep over the time when NRF rolls around. It's very easy to go there and be swept up in all of the technology. Leighton and I have been several times now. It's a situation where you go and you see all this fantastic technology, but a lot of it, there's not really proof of concept for. And I think this is where my resolution comes up. We need to stop looking at all of the technological developments at NRF as something that is immediately around the corner, something that's going to impact retail stores immediately, and more like things that are going to take 5 to 10 years. Even the things that have proof of concept. I remember several years ago going to an NRF big show, and Kroger and Microsoft had this team-up booth there where they were talking about shelf talkers being digitalized on the edge of store shelves. You really don't even see that in newer Kroger stores at this point in time. So it does take time for these mechanisms to come about. But I saw a mechanism this week at NRF. Now, I'm not physically there. I've got a conflict of schedule coming up this week, so I couldn't make it out this year, unfortunately. But there's a shopping cart that is designed to mimic the e-commerce experience of e-commerce grocery for a grocery store. Now, let that sink in a little bit. It's a brick and mortar device designed to mimic the e-commerce grocery platform. I can't be the only one that thinks that part of what's holding e-commerce grocery back is that the e-commerce grocery platform is not as appealing as the store. It's a lot more appealing to go in, see what deals are there, see the freshness of the produce, something that we've talked about time and again. E-commerce outlets and the likes of Kroger, Albertsons, Safeway, etc. are trying to make their online mechanisms be more appealing. So now we have a shopping cart that's designed for, again, millennials and Gen Z folks, even though we have data that suggests that Gen Z folks might be more in tune with brick and mortar than we think, designed to mimic that e-commerce presence in store. Why? We're still trying to get e-commerce for grocery right. So that's what I mean by let's pump our brakes a little bit. Let's look at this cool stuff, agree that it's pretty neat, agree that we might see it someday, but also bear in mind that it's not likely something that we're going to see immediately. And even a few years ago when we were at the NRF's big show in New York, we recorded probably 15 interviews that we used on the show during the next few months. And even looking back at some of those, a lot of those products haven't hit market, even though they were further along and had proof of concept. So again, just kind of a resolution. Let's pump our brakes. Let's be pleased to see these things in 5 or 10 years, but admit that change in the retail space comes more slowly. And part of it is because customers, as much as we hate to believe it, are more hesitant to change than we believe. And it is more difficult to push customers to shop a particular way than we think. After all, you look at self-checkouts in stores. They came out in the 90s. I remember Kmart I was working at had self-checkouts in the 90s. Ended up having to take it out because it was too early for people. Now people are more accustomed to using them, but we're talking 25 years later. So, like I said, everyone catch their breath, enjoy NRF. It's always a good time. Just keep in mind that change happens oftentimes at a glacial pace.
How dare you talk with reason, sir? Speaking of change and speaking about the future of a particular business area, I'm going to be switching gears a little bit to the mattress company Casper that last Friday they filed, guess what? Their IPO paperwork to the New York Stock Exchange. They're going to have ticker symbol CSPR. And this is going to be a big story because this is a company, Trent, that has not, to what a lot of people would like to say, disrupted an entire industry. Not yet, anyway. Yes, they've put up around $312 million in revenue for the first 9 months ending in September of 2019. They have double-digit sales increases, but the problem is they've been hemorrhaging a ton of cash due to marketing expenditure. They've spent a lot of money advertising on podcasts, just like this one, although they have not been our sponsor as of yet. Casper, if you're listening, please sponsor us. But overall, you're seeing a company that does not make any money and has not since its inception. And the reason being is they want to get as big as possible and try to promote their own brand and try to get basically a very prominent name out there in the mattress industry. And while they sell direct to consumer, they have said recently, as recent as 2018 and 2019, that they want up to 200 stores, if not more, in North America. So they're not going to only sell online. They also want a brick and mortar footprint. And it's interesting to me, Trent, they already have 60 stores, but right now, it's kind of tough to tell. We don't have all of the paperwork. They're not yet a fully publicly traded company. So we can't tell if the stores are actually doing as well as maybe the management would like to see. And so you're seeing a company that right now has spent up to $500 million in marketing expenses since 2016, and a company that loses double-digit millions of dollars every single year. So the big question is, how much will they be able to demand from investors right now with this IPO, this initial public offering, and what exactly are they going to do with that money? Of course, they have to lay out these details for the investment banks and the institutions and the regulatory bodies, so that's going to be interesting to dig through. But as of now, Trent, this is a startup that has just a slice of the pie, a very small slice of the pie. And what's interesting, and what's maybe a negative sign, something you actually see on Shark Tank that's usually a negative sign for the sharks when they see an entrepreneur come in and they note a market opportunity. And Casper did just that so far. And I quote, they quoted a market study with $585 billion in market opportunity for the world with the sleep economy. And again, the sleep economy, things that have to do with humans sleeping. They said there's a huge opportunity out there, and if we just get a small piece of that pie, we'll be fine. They quoted a $95 billion US opportunity for sleep. And I think that's just very interesting because it speaks to a handful of products, of course, not just mattresses, but they're basically saying that sleep is now viewed in the US as something that is not just something that we have to do, but it's part of our human existence. It affects how we produce during the day at our day jobs, and it affects our general health and well-being. And while those are very fair points that we've known for quite some time, that's not going to sell mattresses. That is not telling us the larger story about your business in the years to come. So I'm very curious to see how the business and the investors respond to being a publicly traded company and how overall those quarterly reports are going to be looking, as we'll report on the Retail Focus podcast.
Yeah, it's kind of interesting because you see so much momentum, perceived momentum surrounding Casper, but certainly a lack thereof around some of the legacy retailers like Mattress Firm, for example, who has agreements with a number of those bed-in-a-box companies. So very interesting times as it pertains to sleep retail, if you will, in the U.S. Well, that'll do it for us here on the Retail Focus podcast. For Leighton, I'm Trent. Once again, a big thanks going out to Michael Hurst with Starch Creative joining us on this show. We've got another great interview stacked up for next week. I'm going in for surgery this week. We hope we'll have a podcast next week, but if you don't, it's probably because there's some complications or some such thing going on with it. But we'll keep you up to date on our social media channels. Again, Twitter and Instagram at Retail Podcast, and we'll be back with you soon.
This has been the Retail Focus Podcast. For more, visit our website at retailfocuspodcast.com and subscribe on iTunes or Stitcher. Follow us on Twitter at Retail Podcast.